One of the highest yielding stocks I own in my personal dividend portfolio is Altria Group, stock ticker MO. And in fact, if we jump over to my do-it-yourself investor toolkit, we can actually see this is a position that's currently paying me over $333 a year in dividend income. And if we jump over to the investment dashboard, I blow up my growth chart just a little bit. You can see it's a position I'm up slightly on, around 3.32%. Now, this company is currently trading at $42.20 per share, but over the past year, it's down around 10%, and year to date, down around 8.28%. So in this video, we need to decide, is Altria Group trading at a good price at $42.20, and should we consider adding it to our portfolio? And like I mentioned, the starting dividend yield for this company, very nice, sitting at 9.39%. So that is a very high starting dividend yield. Now, the goal with my dividend portfolio is to one day be able to live off dividend income. And I think it's extremely important that I invest into companies that have the ability to increase their dividend payouts over time. And so while typically when you see high yielding dividend companies, they don't increase their dividend payouts, that's really not the case for Altria Group. In fact, if we look at the dividend history, they've been increasing dividend payouts for 53 consecutive years, making them a dividend king. And if we look at that dividend history over the past 10 years, again, you can see a steady history of increasing those dividend payments. In 2013, going from 44 cents per share quarterly all the way up to around 98 cents per share quarterly in 2023. So when we look at these dividend growth rates, I'll scroll down, you can see over the past 3 years, it's sitting at around 4%, 5-year dividend growth rate of around 5.85%, and the 10-year dividend growth rate sitting at about 7.76%. So typically I like to see it a little bit higher than this, but when you consider the fact they already have a starting dividend yield sitting at over 9%, that's pretty phenomenal dividend growth over that time period. Now, the really important question with Altria Group is how safe are these big dividend payments that they make every single quarter? So we need to jump over to the dividend safety tab, and this is something we need to talk about for a minute. Now, we need to keep in mind dividend payments are paid out of free cash flow. And again, there's 5 different things a company can do with free cash flow. They can reinvest back into the business, they can pay down debt, they can buy back shares, attempt mergers and acquisitions, and of course, they can pay out dividends. And whenever you're looking at things like cash flow payout ratio, you want to look at what management's capital allocation plan is. And this is actually something I was able to find after doing just a little bit of digging. Now, the first thing we can see is that they are targeting mid to single digit dividend growth per share annually. And like we saw with the dividend growth rates, it looks like they have been doing this. Now, what is their target payout ratio though? If we jump over to the 2022 annual report from Altria Group, we can see that they have maintained a dividend payout ratio target of approximately 80% of our adjusted diluted earnings per share. So if we jump back over to Seeking Alpha, we can actually see they're very close to being in line with this. They're slightly below it with their earnings payout ratios. But again, I also like to focus on the cash flow payout ratio because dividends are paid out of free cash flow. And we can see with the cash flow payout ratio, it's sitting at around 82.41%. Again, pretty close to that target 80%. So off first glance, yes, this is obviously a pretty high payout ratio, but their management has decided that the best way they can reward their shareholders is in the form of dividends. And as of right now, it does appear that these dividend payments are safe. Obviously, we want to see sustainable growing free cash flow so that they can maintain those dividend growth rates and the dividend payout ratio of around 80%. So now we've got some good insights into the dividend metrics, but we still need to answer the question is it trading at $42.20 a good price to consider buying in at? To answer that question, we are going to jump over to my stock valuation spreadsheet and look at a few different valuation models. And like all the rest of my spreadsheets, if you'd like to join a community of dividend investors and be able to download any of my spreadsheets, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in stock ticker MO and hit enter, and all of this data will automatically load in. Now again, we've already touched on it over the past year. The share price has been a little bit choppy, but definitely trending downwards. We can see the 20, 50, and 200-day moving averages all in a relatively a close area. Analysts have a target price of around $46.51. Institutional ownership really not that high with 59.25%, and a beta of just 0.66. So when a beta is below 1, it means you'll see less volatility than that of the market. So this is not considered a very volatile stock. Now, the first valuation we will look at is Graham's valuation, a valuation model invented by Benjamin Graham, and basically it's valuing a company based on their projected earnings per share growth. So we can see we have our earnings per share for Altria Group right here. We then have our growth rate projection. We multiply it by 4.4, which is the average yield on AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds. And it has come down a little bit over the past few weeks, but it is still sitting relatively high at 4.52. So when we plug all this together, we come to an intrinsic value of $50.70, a little bit above that current trading price. The next valuation we'll look at is the discounted cash flow analysis. Again, extremely important that Altria is able to continue to produce growing free cash flow so that they can pay out those growing dividend payments. In this scenario, after looking at analyst and industry projections, I am projecting a low growth rate for free cash flow of around 3.5%. After plugging in all these other variables such as cash and cash equivalents, total debt, and dividing by shares outstanding, we come to a DCF price per share of around $59.71. So that's actually a pretty good valuation despite the low growth rate for Altria Group. Keep in mind this also comes with a 9% discount rate. The next valuation we'll look at is the multiples valuation. And basically what we're doing is we're looking at how the market is valuing companies that are similar in structure. So you can see Philip and Morris, we have UVV and BTI. We're taking the stock price, dividing by the earnings per share to find their price to earnings multiple. The average PE for these companies is only sitting at 12.4. And if we jump over to the stock screener, we can actually see the price to earnings for Altria right now, sitting at a low 8.61. So these companies really aren't something I would consider trading at a premium. But if you were to apply the same price to earnings to Altria, their intrinsic value would come out to around $62.65. So the last valuation we'll look at now is going to be the dividend discount model. I'll go ahead and zoom out just a little bit. And this is one of my favorite valuations for a dividend stock, assuming that those dividend payments are safe. But essentially what we're doing is we're seeing how much a dividend stock is paying out and projecting how much it will grow in the future, and then we'll be able to calculate the intrinsic value based off of that data. So I plugged in the historical dividend payments for this company so we can see those yearly dividend payments. They did just recently hike their dividend payments by around 4.26%, making their quarterly dividend payments 0.98. But we can see the growth rates of around 2.38, 4.65, 4.4, and 4.3. Pretty consistent low single digit growth, just like we saw from management. But moving forward, I'm projecting a low dividend growth rate of around 2.5%, discount rate of 9%, and despite the low dividend growth rate, we still come to an intrinsic value of $61.82. So when we jump over to the output tab, we can see the four valuations that we use: grams at 50, multiples at 62, DCF at around 59, and dividend discount model at around $61.82. When we average all four of these together, we come to an intrinsic value of $58.72. That's actually a pretty big difference from the current trading price. So with a 10% margin of safety, it looks like our acceptable buy price for this company sitting around $52.85. And if we jump back over to Seeking Alpha, we can see it's actually been a little bit of time since they've traded in that range. And around August of 2022, it looks like that was the last time they traded above $50 a share. So I think the main thing holding this share price down from its intrinsic value is investors have concerns about the safety of the dividend, and they also have concerns about the growth from this company. Now, you shouldn't invest in this company if you want to see hyper growth. Again, they're not focused on reinvesting back into the business, but they're more focused on rewarding shareholders with their dividend payments. So again, the big question is, how safe are those dividend payments? And when I look at this from a short-term perspective, I do think these dividend payments are relatively safe despite them being very large dividend payments. Now, long-term is where some people are concerned. Are they going to be able to continue to increase their free cash flow year over year at a rate where they continue to pay out those high dividend payments 10 or even 20 years from now? That's the big question. So as for me and as for now, I do think Altria is actually trading at a pretty decent value, but I don't plan on adding more to my personal dividend portfolio. I already have a decent size in this position, and I typically focus on companies with higher dividend growth rates, but I do like the combination of yield and decent dividend growth that I've seen from Altria so far. So there you go. There is a quick analysis on MO. Go ahead and let me know what you think of this company in the comments down below. And like always, if you'd like to join a community of dividend investors and get access to all of my spreadsheets, you can head over to my Patreon page at the link in the description. You can also get a huge discount to Seeking Alpha at my link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.